मला असं सांग. A very good evening to all of you. I am CS Smriti Sabnis, working as Senior Manager at Direct Taxes at RRCO, and I welcome you all at this Budget Pe Charcha 2026 Season 2. So, this is our annual knowledge sharing platform where we discuss the Union budget and its real world impact on businesses and professionals. So, for this year's edition, we have with us CA Parag Rathi, Managing Partner at RRCO, a specialist in domestic and international taxation.
Thank you.
We have also with us CA Nemin Shah, in-house Principal Advisor, Direct Taxes, with rich experience in tax advisory, litigation, international taxation, transfer pricing, and FEMA. So, together we will share practical and actionable insights on Budget 2026 mean for business and cross-border operations. So, let's begin. So, definitely this year is not a common man budget. There are a lot of welcome reforms, but one of such welcome reform is not on the amendment but reform, which is Income Tax Act 2025. So with over the years, this law has become so much complex with respect to rules, regulations, amendments, proviso, explanation, judicial interpretations. So last time also government, our Honorable Finance Minister has announced that Income Tax Act 2025 will is a move towards simplification. So, do you think this is really a move towards simplification? Over to you, Nemin sir.
So, I mean, there was an expectation for a while that they were likely to defer the implementation of the new Income Tax Act by a year because we still haven't seen the rules and the forms and etc. And I mean, I'll give one very basic thing. On 1st of May, when we try to pay TDS, the income tax website has to show the new provisions of the Income Tax Act 2025. If it doesn't show, how are we going to pay the TDS? So those are some very practical problems which we may have. The finance minister has assured that the rules and forms are imminent. So let's hope for that. But no, it is not deferred, and it definitely is coming on 1st of April. As far as simplification is concerned, I think this budget itself is an example that it really isn't simplification, because a law which has not even started, there are more than 100 amendments in the law which has not even been enforced as yet. So I think we are still in the transition phase. I do believe maybe in the next 5 or 6 years, maybe the law hopefully will settle and we will see lesser amendments in the budget.
So with the rules not yet rolled out, do you think this amendment is more into haste? Means the government could have waited, right? So
ideally they should have. I mean, I would have liked a draft, like the draft act was put out. I think the draft rules should have been put out for stakeholder comments. That way, some small issues here and there could have been sorted out. But I think what my sense now is that, considering we are already in the month of February, the possibility exists that they will do the same thing what they did with the labor code. So the new labor code came into force from 21st of November 2025, but we still don't have the rules. So they came out with a clarification in early January that the old rules will continue to apply till such time as new rules are notified. My sense is they might do something similar in this also. They will say that the old rules will continue to apply, and that ways we will make our transition into the new Income Tax Act.
I will come to you now, Parag sir. So
on the same point of having 1st April as a starting date for the new Income Tax Act, it was put in for consideration for a long time. The parliamentary panel debated on it and it was notified to be implemented now. While I agree with Nemin Bhai that there was a larger expectation that it should be deferred for the future implementation, But historically, if you look at be it GST or be it all other provisions of the Tax Act, this government is trying to push in the reforms. And when you are pushing the reforms, sometimes it so happens that industry doesn't have enough time to ponder upon the rules and get it implemented. But I am in support of view that effective 1st April the new Income Tax Act is in place, and the rules government said they will notify very soon, and wherever required the relaxations will definitely follow. So I feel this is a good move that they started on 1st April, because in mid of the year it would have been again a mess that how much of taxes you pay as per the previous provision and the new provision and things like that. So that's first part of it. And as you mentioned in one of your question early that it is not a common man's budget, as you know, there are a lot of reforms, but generally it is expected every time that there's a relaxation on the individual taxation, and then only people say it's a common man budget. But the way government approached this year the budget, specifically showing trust on the taxpayer, giving taxpayer an opportunity to correct the mistake rather than directly penalizing it, I feel definitely there is something for a common taxpayer in the budget. If there is no tax concession, at least there is a relief the way they are looking at taxpayer, rather than giving taxpayer opportunity rather than just pushing the penalties forward for every mistake. So that's my take on the current budget.
So, I mean, I will also add to Parak's thing that the taxpayer already got a very large relief in the previous budget, and now I think we should feel satisfied with this. I mean, this is as good as it has ever been in if you look at the past 10-12 year record, has it ever been that from a non-taxable income of 7.5 lakh, we've jumped to 12.5 lakh in one budget. That is, I think, sufficient. Parag sir, what do you think? For a couple of years easily now, we should not be asking for it anymore now. I've been seeing a lot of social media posts saying, oh, make it 15 lakh. That's ridiculous. I mean, government has given so much already to you. Let's be happy with that rather than keep on asking for more. I think we should be happy with what we have.
That's a long debated topic. If we go on to debate, I think 1 hour won't be enough.
Yeah, so again sticking to Income Tax Act 2025. So how do you see this transition and playing out for the tax professional in practice?
So I think a lot of people have to start taking, if you ask me honestly, my experience has been in the last 4-5 months, they are still not taking Income Tax Act 2025 seriously enough. I think it's high time now that professionals take this seriously and start getting themselves ready, because otherwise on 1st of April, the act will come and they will have no idea of what's in there. So even though the government has said that that Income Tax Act 2025 is more or less the same as the old law, but there are subtle changes in the language, and I think professionals need to start getting themselves acquainted with this and take this seriously. Even industry for that matter hasn't been taking it seriously at all. So I think it's time now both professionals and industry start believing that now this is it, the Income Tax Act is coming, and we need to start getting ourselves acquainted with the minor changes which are there.
That's true. I think what Nemin said at the end is the minor changes which we need to get more acquainted to. Otherwise, from a philosophy perspective, it still remains the similar way of compliances. So, definitely industry and practitioners would need to spend more time to get acquainted to those minor changes and get used to the new, Income Tax Act in whatever new phrases and new sections and new definitions which they have brought in, including the simplest one being assessment year and financial year. Assessment year has been done away with for so many years. We are so used to talk about assessment year. Now we would need to start looking at financial year as a tax year, which is how it is. But yeah, I am sure people will adopt to in a month or two.
So tax professional like us now need to read 2 acts like Income Tax Act 1961
Absolutely.
for litigations and for Income Tax Act 2025 for compliance.
Litigation will at least go on for at least a decade, if not longer. So we need to know both the laws.
That's right.
This budget actually is a good example. When you see the explanatory memorandum, it refers to the section numbers of both. So and I had to spend a lot of time reading the budget this time, because it was, we would read both this section number, we don't even know which
even
section.
the date of effective amendment, it was also confusing.
So in the old, it's when the same sections are amended under both law, under Income Tax Act it is 1st March in many cases, and under because it can't be 1st April, because there is a sunset clause on 31st March. Income Tax Act 1961 ceases to exist. So all the amendments which they are trying to rush through are from 1st March, whereas the new Income Tax Act, all the amendments are from 1st April. So in that sense.
With this, let's move to next amendment. So definitely budget 2026 focuses on India's digital future. So the finance minister has proposed a long-term tax holiday running all up to wait 2047. So for foreign companies that procure data center services from approved data centers located in India. So the intent is clear, like make India an attractive destination for global cloud and AI driven businesses. At the same time, this proposal had some guardrails, like for instance, where services are provided to Indian users, they must be routed through an Indian seller. And the benefits are also limitation. So do you think, or looking at this proposal from the investor's lens, does this tax holiday have the potential to be a real game changer for India's data center ecosystem?
Absolutely. If this is implemented well, and again, the key words being, if this is implemented well, this is going to be the next logical step. So we've been a IT hub for for a couple of decades now. This is the digital, this is the logical next step, to be a hub for a data center. Having said that, I think in India, we've always had, the best of intentions, but the implementation always becomes a question. So we need the government to step in and make sure that the implementation is handled well, because there's always going to be overzealous officers who are going to pass strange orders. There will always be overzealous prosecutors who will go and argue the seemingly illogical positions before courts. And I think with the Tiger Global now, we are sure that the courts are also sometimes likely to adopt views which are not something which was expected by the investors. See, I think there is one misconception which a lot of Indians have, that foreign investors don't want to pay taxes. I think that is an incorrect misconception. I think it is the foreign investors are very okay paying taxes so long as you tell them on the first day that this is going to be your liability. What they don't like is uncertainty on the first day being told that there is no tax, and after 2 years being told that now there is a tax. So that is where I think we need to manage the expectations. And maybe I think if you see this, the language is not very appropriately or happily worded. Maybe the government needs to tweak the wording a bit to make sure that the intention and the implementation are all in sync.
Okay, fair enough. So, do you
I
want to
agree.
add anything?
By 20, we're talking 2026 and we are giving promise for 2047. That's a very long period of tax holiday which we're talking. So definitely there should be a policy certainty. Every year we have amendment in the budget and the tax rate and the provisions around the way the tax laws are governed in India. So therefore, giving that certainty to a global investor will be of a more important than the way we are promising the incentive for such a long time. But it is definitely a welcome move to bring in more data centers and bring in digital economy to India.
So continuing with the theme of attracting global investment, Budget 2026 also introduced important measure for International Financial Service Center, or what we call as IFSC. So this budget proposes a significant deduction to IFSCs for 100% deduction for 20 years out of 25 years. So do you think this is a meaningful step?
Absolutely. So I mean, IFSC is definitely something which is going to be the future for India. I think it is going to attract a lot. I have personally been to the IFSC in 2023. It's actually a great place. I think in terms of policy, I think we also have one very good thing in IFSC is that there is a single regulator. IFCA is a single regulator for all laws. I mean, that is something which is very unique to India. Otherwise, you're always looking, at different regulators. There is a different regulator for FEMA, a different regulator for company law. Whereas in the IFSC, you have one regulator. So definitely, I think in the next 10 or 12 years, I believe IFCA is the dream of our Prime Minister, and I believe that the dream is going to be a very big reality very soon. I think, but we still do need, small initiatives. I think when I was at the IFSC, I think there was a lot of optimism there, but also a little bit of frustration that things are not moving fast enough. Reform is not moving fast enough. Maybe, Parag, the government can consider like a expert committee to, keep reviewing and giving proposals which can comprise of even industry experts. So, things will move fast. But of course, credit to IFCA, they take on the representations very well. But somewhere I think we need that urgency now. I think the next 10 years, we want to make IFCA as great as the Prime Minister has dreamt about.
I completely agree. But at the same time, government is very open to the changes to make sure that whatever challenges industry is facing in IFSC, it is getting resolved. So from a practical perspective, I have seen in last 6-7 budget, every year there is some amendment for IFSC,
right.
Yes.
which is coming in. That shows that the authorities are in touch with the lawmakers, and there are amendments which are coming in. So we are also hopeful that it will have the real impact which is expected by our Prime Minister.
Okay. Next, moving on to, government has introduced time to time settlement schemes. So this year also there is a settlement scheme for small taxpayers to encourage them to declare their foreign assets, undisclosed foreign assets and income and to bring them into the ecosystem. So who exactly should be considering this seriously as an opportunity is my question.
No, this is a massive. I think this is it's by the way, the short form is FAST. It's a
Okay,
fast scheme.
Yes,
Fast.
Oh, nice.
So it's a very good scheme. I think this is something which was very much required. I think there are a lot of taxpayers out there who have not understood the foreign asset disclosure, and fair point to them. Honestly, if you look at the foreign asset disclosure, Parag sir, sometimes I have to sit with it and read it 2-3 times to understand where does a particular disclosure go. So it is extremely complex. And our government is encouraging people to file returns on their own. So if you do that, then you have to make it a little bit easy for them. Having said that, now since it is known, people should take benefit of this, and those who have made innocent non-disclosure of foreign assets where their income is otherwise accounted for, but only the assets have not been disclosed due to oversight. This is a great opportunity. I think I believe they'll get away with a penalty of just 1 lakh. That too, even if it's multiple years, they have to pay only 1 lakh for the entire default. So say somebody has missed disclosing an asset for 5 years, and you can still just pay 1 lakh and get away with it. The scheme also allows that in cases where the proceedings are ongoing, will also be eligible. So I think it may also be prudent for those where proceedings are ongoing to write a letter to the officer informing that the scheme has come and we are considering this, so that in haste some order isn't passed. Even though I believe what I understand from some that the officers themselves have been informed not to pass any orders, but just to make sure that we are all on the same page, it may be a prudent thing to just write a one-pager letter saying we are considering the scheme. So right now, please don't pass any orders till the scheme comes in. But this definitely is a golden opportunity for us to make sure that all the past sins on foreign assets are wiped out, and also to make sure that there are no future sins. Now we have to be very clear on what has to be disclosed in the return.
See, what I agree, Nemin, by what you're saying, but the point is the foreign disclosure requirement emanated from the Black Money Act, so which was 2016, and it was expected that there is large amount of cash which is stashed outside India in a black money. People are not paying taxes, they're non-compliant, and that's what it was expected to be covered under this. But what happened in last 8-9 years is that a common man who is going out of India for some employment for few months, opening up a bank account, having some balance there, or having some ESOP issued from a foreign entity, these kind of cases were getting covered in the Black Money Act notices, and the penalty was 10 lakh rupees, as in
for every year.
For every year, yes. And for $200 balance in a bank account in a foreign country which got inadvertently not reported, and there are penalty notices of 10 lakh where tax officer is saying I have no option, I'll have to levy penalty of 10 lakh. So the intended consequence or intended regulation which was required under Black Money Act did not follow. What it resulted into is penalizing small taxpayer. So therefore this scheme is very delayed but definitely welcome. It has two categories. In one category it says that if you have a foreign asset or foreign income which is not disclosed and which is below 1 crore, they say that you disclose, you pay tax on that at 30%, and plus you pay 30% penalty. So it's like double the tax amount. This was never intended to be part of general black money disclosure, but now that because in 8-9 years there are so many notices and so many conversations, therefore this bracket was introduced. So I think the penalty could have been little lesser if at all there is need for, but then having 30% tax and then 30% penalty is little onerous to the small taxpayer having less than 1 crore of income, and the mens rea should have been definitely looked at in general, but which I think is missing presently. And the second category is up to 5 crore of your foreign assets. There is no income. There are foreign assets which you have stashed outside India and you did not disclose in your tax return. Then they have said that if the tax is already paid in India, you pay 1 lakh rupees worth of penalty and move forward. So they've categorized it in two way. One for less than 1 crore, less than up to, and one for up to 5 crore. So definitely one has to evaluate and see if there are any notices, if there are any non-compliances for the past year, they should make it good and move ahead with. The best part Nemin bhai mentioned is that the 1 lakh rupees fees which we are paying is only for 1 year. Even if there are 5 returns where I am required to disclose my assets, I did not disclose it at 1 year, I don't pay penalty for every year. I pay only 1 lakh rupees once, and then everything is regularized. So this is a good opportunity for everyone who missed to report, for everyone who felt otherwise that this is not required to be reported in India. They should look at it and report and get over with under this scheme for sure.
So in fact, one more aspect which people need to worry about here is that this scheme does not give you immunity under FEMA.
FEMA, exactly. I was coming to it
So
actually.
we have to evaluate, and in cases where there is a FEMA violation also, we need to take appropriate action, including applying for compounding, because otherwise the situation is that you are getting away with one problem, but
You
then
will
you're
get into
creating
another
another
problem.
one. So especially in cases where notice has not yet been issued, and mind you, those people also, Parag sir, I want to add that don't wait for the notice to be issued. Even if you know that you have made a non-disclosure, this is the right time. This is like the you are at the you're near the river Ganga. Take a dip in it and wash off your sins, because don't wait for someone to say कि तुमने पाप किया है. Just go and, if you know in your heart that you have done a pap, then go and cleanse yourself, because otherwise the penalty will be 10 lakh rupees for every year in the future.
My experience with FEMA has been it is more of a compliance, and RBI is very welcome if you go ahead with the facts, explain them, and they pass orders with the LSF,
Absolutely.
late submission fees, and they have been regularizing it. So therefore, a taxpayer should not worry. They should regularize it into the taxes
No,
and
absolutely.
also regularize in FEMA.
I'm only saying that they have to take care of the aspect. Don't forget to deal with FEMA. Is my point.
Agree.
Yeah.
Okay, with that, let's move to next amendment. So something we are seeing more and more this year, that is buyback of shares. So companies love them, investor usually like them, but the taxation of buyback was always confusing.
And finance minister loved it in last 6 years.
Absolutely.
So because the taxation of buyback was always confusing, and one more twist in this budget is the separate taxation treatment for the promoters. So is this a policy signal, and how promoters and companies should respond?
The two things which has happened, in the buyback, there has been multiple amendment. There was buyback distribution tax which came. There was taxable in the hands of company, exempt in the hands of individual. And the latest one, which was until the current year, is the surprising amendment where we said that buyback is not treated as a capital gain. It is treated as a dividend now. It was defined as a dividend. So I buy shares worth of 1 lakh today. I sell it at 5 lakh. Technically, I made a profit of 4 lakh, as in sale as in buyback at 5 lakh. So technically, I made a profit of 4 lakh, which is taxable as capital gain. But in the current provision, the government bought it as deemed dividend, wherein they said that this not 4 lakh, but total 5 lakh is treated as my dividend. So they don't give me a deduction for 1 lakh worth of purchase value. If the buyback is at 5 lakh, I should be paying tax as a dividend at 5 lakh. As a dividend, I mean at the maximum chargeable tax rate which is applicable to you,
30%.
and the 1 lakh which is cost of acquisition is allowed as a capital loss to be set off against future capital gain. There is a belief that I will continue to invest into some equity. How do I set off that future capital loss? So this provision was very confusing. Why was it bought in? How did it came in? But it is there on the statute today. The new amendment is definitely a welcome step, where they said that no, it is no more a dividend. It is now a capital gain. So now anything on the buyback side remains to be the capital gain. Continuing with the earlier example of 1 lakh and 5 lakh, the 4 lakh rupees will now be treated as a capital gain, short term, long term, depending on period of holding, and appropriately taxable at 20% or 30% or 12.5%, depending on the tax rate. And the dividend part of it is now over. So I think that's the best move to happen. And as far as you mentioned, for the listed company promoter, that now there is a 10% additional tax, which is 22% for short term and 22% for long term. So broadly, it is coming from a super rich tax thought process that the government has been trying to mention in past budget, that they want to come up with a estate duty taxation, that promoters which has large part of money, they would need to pay little higher share of tax. That has been a strategy for long time, and therefore they have a little higher tax, and they've tried to rationalize it with the dividend taxation rate. Also with a global capital gain tax rate, because there were cases of people externalizing the structure and having their holdings outside India and just becoming a non-resident before their selling of their startup or any company. So all these kind of structures were coming in play. Therefore, government moving back to the capital gain and bringing a reasonable tax rate is a good move. And 22% for promoters should not be a sign of any distress, in my opinion.
So, Smriti, this is one more change which is good for the common man, because if you are a minority shareholder or a public shareholder in a company, then now for you your buyback rate is now back to 12.5 for long term and 20 for short term. Also, Parag sir, this will apply to unlisted entities also.
Correct.
And there the promoter definition is going to be tricky, because they say two things: either you have to be a promoter under Companies Act, or you have to own at least 10 or more percent. Now, what can happen is, promoter under Companies Act is fairly straightforward, but 10% will be, I don't know, sometimes you can be like a angel investor and you can still have more than 10%. In that case, to count them as promoter would be a little harsh, I would say, especially because a lot of them may not be running the business on a day-to-day basis. Maybe the threshold could have been a bit higher, maybe 25%, or
maybe instead of percentage it should be for amount, because the intent is to tax super rich.
Absolutely.
Intent is not to tax everyone.
Absolutely.
Out there. Yeah.
So for the promoters, the tax rate remains the same as was for dividend, but the characterization is capital gain. So that also is an advantage for them, that they can look at 54F as a potential. If they're buying a house property, then they can get an exemption, because today it was deemed dividend, so they could never have gotten that exemption. So that ways, in that sense, even for promoters, it's a good move.
True.
But having said that, I would say 10% is a little low threshold. I would have been happier with a slightly higher threshold, because it will affect some people it will again have unintended consequences for people who are not necessarily actually promoters.
Okay, so considering the common man amendment, so sovereign gold bonds are considered as the most tax-friendly gold investment. So with this budget, the government has drawn clear boundaries around the exemption. So how the investor should read this amendment? Or will it affect the long-term attractiveness of sovereign gold bond compared to other gold investments?
See, practically the small investor who invested in a sovereign gold bond was at a time of entry and he was there to hold it till maturity. But there are a lot of traders who got in between, and they were taking advantage of non-taxability as well as getting interest. And strategically, many people were trying to trade into sovereign gold bonds by coming in between and kind of selling in before maturity. Apparently, it is now getting discouraged. In the earlier law also, it was clear that if you sell before maturity, the tax exemption was not there, but the entry point was permitted to be at any time, as you know, which now got clarified that entry point needs to be at the time of issue and exit should be at the time of maturity. So if you are a serious investor, buy it at first day, hold it till last day, and then you get a tax exemption.
Right.
If you are getting something in between, then you would need to pay tax. That's what something which they have come up with. So I think that's a fair expectation of government. The intent of sovereign gold bond and giving 2.5% interest on holding that gold bond was to let people hold it in a paper form and reduce the import of gold unnecessarily to match the capital account transactions and balance of trade position of country. Therefore, in that intent, tax incentive was never a main purpose of sovereign gold bond. So that was an added advantage as an attraction to a retail investor. So in my opinion, it's just a clarificatory amendment which is a welcome step, and it goes with the intent of sovereign gold bond, where government doesn't want people to come and trade. Government want people to invest in gold paper, as in white gold.
So, I mean, I slightly disagree with you there, that in the sense that there are many genuine investors also who may not have opted for the sovereign gold bond at the time of the issue, but later on found it to be attractive. So they would have gone to the secondary market, and in the secondary market, I'm told that it is trades at a slight premium because of this. So they bought it at a premium, thinking that they will hold it to maturity. So my point is, I agree with you that if they want to discourage a certain practice, they can implement it prospectively. What has unfortunately happened here is those who have already bought the sovereign gold bonds also will not get the exemption.
Exactly.
So when you are making an investment, you have a little working how much is going to be my total gain, there they would have taken into account the tax benefit.
exemption, yeah.
So then to that extent you are messing up their work.
The grandfathering needs to be bought in, is what you're trying to say.
I'm saying
from a
exactly that,
transition
or some kind of a transition provision where you say that, okay, up to this day, so up to 31st January, if you bought it like they did for capital gains, okay, up to 31st January, if you bought and you hold to maturity, it's fine. If you buy after 1st February, then we will not give you the exemption. That sounds a little more reasonable. Here, you are unnecessarily. So I agree with you that you want to definitely you should be discouraging traders. And right now, the way the gold prices are moving up, I think everybody is. I'll tell you honestly, I also looked up sovereign gold bonds in the secondary market a couple of weeks ago to see can we now get in, because it's going up so much.
We will send this clip to Finance Minister on Twitter and make sure that at least some grandfathering related aspect government considers. But yeah, as in I agree with Nemin.
Okay. So now I will come to rationalization of TCS. So over last two to three budget, the government is reducing TCS and TDS rates, increasing threshold, and same is in this budget as well. So by moving a flat 2% TCS with no minimum threshold, do you think this amendment is less about earning that 2% and for better tracking of the transactions?
If it is better tracking of transaction, they should do it by way of SFT. So there is already a SFT mechanism where you can report. So bankers can report every foreign payment of education or whatever to the government, and it can be seen into my AISTIS and Form 26AS.
Right.
Why is there need for 5% TCS or 2% TCS? So I somewhere feel that why is government not understanding that there is a large amount of people with a limited means are still eyeing foreign education or still eyeing a medical requirement outside India, while there could be a requirement people to pursue education and medical in India, but people are still going out. When they're going out, they're taking loans, they're borrowing money, and of that you are blocking 2%. Reducing from 5 to 2, I feel maybe good move from a government side, but if you want to track the transaction, track at a SFT level. Why do you track at a TCS level? And if at all TCS is required for whatever convenience purposes, it should be nominal, like 0.01 or 0.1, 0.2, 0.25.
Right.
It need not be 2%. So I feel the money people, when they borrow, when they want to spend, should not be blocked in the taxes. It should be allowed to be utilized for the rightful purposes. And there are enough safeguards when you send money outside India. There are enough safeguards in the present banking system where it gets reported and it gets tracked and appropriately closed, and bankers also demand various documentation before the foreign payments are made. So I feel TCS specifically on the foreign payment should be discouraged, should be bought to a lower amount, and even the tour operator and related TCS can be lesser amount if government want to track the transaction, track it at a nominal percentage instead of 2%.
Also on the foreign travel, I think there is a slight mixed messaging, because a couple of budgets ago the emphasis was on domestic travel, and suddenly now you're reducing the TCS. So it's a signal. People get confused.
I am looking to different perspective. Maybe government is saying that let's collect what is needed, or anyway we have to refund it.
So why don't you increase the tax? Why don't you increase the refund interest on the refunded amount to 12%? At parity with what they charge.
I agree.
If we delay our advance tax payment, we need to pay at 12%. So if you delay my refund, pay me back at 12%. So that will bring parity between government
Absolutely.
and the taxpayers. So.
Okay, so
this clip also should be sent to the finance minister.
Now we are talking about sending clip to finance minister. So there is one amendment which we time to time represented at different forums, and finally in this budget, this was addressed. So I will specifically would like to hear from Parag sir, like this buying property from a non-resident has a lot of paperwork for a resident buyer. Means Indian buyer needs to apply for TAN, filing of TCS return. So finally this has changed to PAN based, and means finally Sarkar ne aapki sun li.
We have been advocating it for a long time.
Right.
Through multiple forums, through BCS, through ICAI, through Maratha Chamber of Commerce locally, as well as we have written ourselves. I have also written on the LinkedIn. The logic is a foreigner who has bought asset in India, NRI, who has moved out of India, why you make his life cumbersome for selling that asset? There is so much effort a non-resident has to go through while he is selling that asset, and by the time he sells it and he gets his money, he gets a feeling along with that money that this is not a place where I need to invest my
Right.
money back, because I am not willing to go through the same pain
Same
process
yes.
of exiting my asset, no, so difficult and so longer way. And therefore money was moving out of India, and people were intending to invest in India, but because of the regulatory requirement they were not. So definitely for a resident who is buying asset of a non-resident, the immovable property, there was a requirement for resident to take a tax deduction account number, go for a lower deduction
Deduction.
certificate,
File
then
TDS
make
return, yeah.
make TDS filing of 27Q and things like that. So it should have been a PAN based. We have been advocating it for a long time. It has no tax impact. It is convenience to everyone, and government has apparently bought that amendment. We have been writing it that instead of something like form 26QB, which is there for resident to resident purchase of property transaction, 1% TDS. Similarly, now there should be something like this form 27QB, where I don't need to apply for TAN and make the compliance. So I think that's a good move. We've been advocating it for last 3 years, and I'm happy that this amendment has come. So we will summarize some of the write-up of this discussion also, and we'll send it to Finance Minister. I'm sure in 2-3 years those amendments will follow.
I think we should keep writing so that one or the
Absolutely.
other day government will listen to us.
That's true.
Absolutely.
Okay, so
Just one point, Parag sir, I think in this, only what has changed is that you don't need to take a TAN. The rate, I think, remains what it was earlier. So we don't have a situation in the new Income Tax Act where the resident will only deduct 1% from the non-resident. I think what we only have is he will not need to take TAN. He can do it with his PAN and the form 26QB. So the second part of your wish list is still pending, I believe.
I would rather say that as long as they allow me to pay the rightful taxes and repatriate my money as a non-resident, it should be good.
Absolutely.
It should be good. Deducting at the tax rate for the total amount of consideration is again a confusion, which I think need to be addressed. I think there is some electricity issue.
Yeah. Sorry for the interruption.
So I think the clarification on the tax should not be levied on the full consideration, but only on the capital gain needs to be addressed, and I'm sure that will follow in some time.
Yeah, maybe a couple of years.
Yeah.
Okay.
Sir, Delhi jaake aao sir ek baar.
Okay, so coming to next amendment regarding the due dates of filing of return for taxpayer with business income. It is extended from 31st July to 31st August, and also revised return due date is also extended from 31st December to 31st March. So from a compliance perspective, I guess August was kind of breathe space for us. So but now again this will be kind of busy season as well for us. So do you think this is a welcome move from taxpayer as well as tax professional?
It definitely is a welcome move, but what would have been better is see, I think everything goes back to because of the TDS. Q4 TDS should not be 31st May. I think we should prepone that to 15th May or maybe even 30th April. Why give people so much time? So if you do that, then you can bring this 31st July date to 30th June and bring the 31st August date to 31st July. The reason I'm saying is because what will happen in most cases is the same chartered accountant would be filing for individuals and for doing tax audit for companies. Every year we will then hear clamor for extension because they'll say, okay, I finished the individual returns only on 31st August. I didn't have time to start doing the tax audit. So I think, professionals need to start planning right now how they want to do this. In my opinion, the best way to approach this is tell your client, I will file return only till 31st July, because what will happen otherwise is people are going to give you data on the 25th or 26th of August, and then you're in that loop then constantly. So whereas this is a welcome move definitely because you're staggering. So also what happens is the portal will not go down because you're staggering the due date. So everybody will not run to file on the same day. The idea of splitting TP non-TP cases was exactly that, because I have been in 2013, I have sat in office for 6.5 hours trying to upload one return.
Oh my God.
Because the site wasn't working. So that way
this staggering can also happen in 15 days time. Why keep it full month? Because generally we've seen that if there is a due date, I agree with that. Every return, maybe 60% of tax returns get filed in the last week of due date. So why keep 31st July, 31st August, 30th September? Make it 31st July, 15th August.
But I think the main thing should be that if they bring this back, if the SFT due date is 15th May and even TDS due date is 15th May.
It should start from there.
It starts from there. So then you don't have to, because right now the entries in your AIS and your TDS 26 AS comes only by 15th of June by law, but not everyone files it on time. So you wait till 20, 22, 23. So what you have effectively is a month and 8 days only to file the return for everybody. So
apart from chartered accountants overworked and trying to do many things, if we can bring in some incentive for people to early file tax return,
right,
that should also promote compliance in a staggered
maybe maybe something as small as a 500 rupee rebate. Knowing Indians love a discount, so you tell them that
everybody loves a discount.
Exactly. So 500 rupees you give them discount. Okay, if you file by 30th June, you will get 500 rupee rebate. I think you are absolutely right. A lot of people will be saying कि चलो चलो data time पे दे दो. So it is much better that way. I completely agree with you on that.
Okay, so we definitely have a lot to discuss, but we have time constraint. So before we wrap up, one question for you is, were you expecting any change in budget 2026 and it didn't turn up? Or something like that, you would still like to see introduced?
I was really hoping for not so many changes, and so many changes came. I haven't done anything the last week.
Even I was not hoping for it, because with the new Income Tax Act, the amendments which have came in, it's really huge amendments.
Right. Yeah. So, no. I mean, I can't think of any. Parag sir, you can think of any?
So I have a little radical idea which I've been discussing with the team, and we are writing. We have already written to some of the Chamber of Commerce. Now we will write to Finance Minister also. I feel as a retail investor, if not investor is retail buyer, I'm a taxpayer, and if I buy something, I'm not a GST registered individual. If I buy something, say white goods, my Apple phone, so I pay some GST. Now this retail invoice is of no use to me. Whether this GST is paid to the government or not is not my interest. I am no more interested to understand that, what happens to this GST, whether somebody pays or not. Those who are businesses, those who have GST registration, they worry because they get a credit of it and then they match it and all that. But the ultimate end user who consumes it and who pays GST, to whom there is no credit available of this GST, nobody is worried about it. So, I have a thought where I feel that if a 0.01% or maybe 100-500 rupees of that GST is allowed to me as a credit based on my PAN, I would want to track it, and I will act as a GST officer every day, where whatever I buy from my day-to-day activities, I will try to save those bill in my record, and I will start getting already Form 26AS and GST portal is linked.
Right.
So if I get an invoice based on my PAN from a retailer, I should get some small amount of that as a credit against my Income Tax Act. If I am able to get that, I am sure every one of us would want to save those invoices, save that bill, and small collection amount from government side, which is given credit to the income taxpayer, a GST credit given in income tax at a very small percentage, will make sure that the retail invoices are reported timely to the government, and I am sure the GST collection will go a little more up.
Also, we will completely stop having the parallel economy, because then everybody will have to start reporting their incomes. And right now, whenever you go to a shop, the question asks, bill ke saath chahiye ke bill ke bina chahiye? That will stop immediately if we do this.
Okay, so definitely that is a good thought. We will keep writing one day this.
I'm sure we will talk about it.
Okay, so overall budget 2026 appears to be focusing on simplifying compliances and reducing litigation. So thank you to our esteemed professional for sharing their valuable insight during this session. With that, we will now move to from direct taxes to indirect taxes. So please stay tuned. Thank you.
Thank you, Smruti. Thank you, Nemin.
चले ना 2 मिनट सही लग रहा है क्या? देख लो स्पेस सही लग रहा है. Yes. Sorry. बटन
Welcome back to our discussion on Budget 2026 Indirect Tax Amendments. Myself, CA Rushikesh Birla, moderator for this session on Indirect Tax. Joining us, CA Akshay Maheshwari, who is a partner at RRCO, leading the Indirect Tax practice. He advises clients on GST, GST refunds, customs, and trade-related matters with a strong focus on compliance, dispute resolution, and practical solutions. Akshay sir, what are your views on the budget 2026 in indirect tax domain?
Actually, if you look at the budget, there is nothing new proposal in the budget for GST. So there was few recommendation in the 56 council meeting. Those has been got a green sheet in this budget.
Yes, that's right, sir. There is a GST council who periodically meets and recommends some changes in the GST Act, and for the rules they are notifying it to the various notifications and circulars, and if there are any changes in the law, they will make it through the finance bill. So it needs to be approved through the parliament. Yes, you are right that there are no more changes in the GST Act. Yes, just we can see there are few important amendments this time. These changes include the place of supply provisions relating to intermediary services, changes in provisional refunds in case of innovative duty structure refunds, and removal of certain conditions related to the credit notes provision. We will take up each of these amendments one by one and discuss them in detail. So let's begin with the first amendments. The budget had omitted some specific place of supply provision relating to intermediary services. Could you briefly explain what this change means and what impact it will have?
Sure. Earlier there was a provision for place of supply for the intermediary services, which talks about that in the case of intermediary services, the place of supply would be the place of the intermediary. Right. Now this rule has been abolished by the budget, and now default rule is applicable in the similar transaction. So default rule says that the location of the service recipient will be the location in the case of the intermediary services from now.
Okay, so can you please explain with some examples for our better understanding?
Yeah, definitely. So let me give you one brief example. So let's say I'm providing intermediary services from India to any company which has been located outside India. So, for example, say in US. So before this amendment, the place of supply was the place of the intermediary. So if we apply that provision over here, the place of supply will become the India, and the transaction will be considered as the domestic transaction rather than the export transaction, and GST will be leviable on transaction, and unnecessary burden of taxes has been passed from India to outside India. So after budget, this position has got changed. After budget, so the place of supply in the case of intermediary has been shifted from India to outside India, from to the person of recipient of the services. So in that case, if other condition related to the export of goods or services got satisfied, then it will be it can be treated as an export of services as a zero rate supply, and GST will not be leviable on the same.
Yes, this is for the export of services. But will this amendment also have impact on import related?
Yeah, definitely. It will also impact on the import related transaction as well. So if you flip the situation which I have mentioned to you, let's say I'm providing services from outside India to inside to any entity which is within India. So in that situation, if you look at the old provision, the place of supply would be the outside India. So service provider is outside India, place of supply is outside India. So there won't be any kind of GST liability, no output liability, no RCM. But after the amendment, place of supply shifted from outside India to within its inside India. So service receiver is now inside India. So he needs to pay RCM on that, and he can avail the ITC against the same.
Yes, that's a great explanation with example, sir. So now the taxpayer have lower burden of taxes if they are intermediary suppliers and intermediary supply importers.
Yeah.
Okay. So the second important amendment that was introduced in the finance bill is that the provisional refund, which has been now extended to the inverted duty structure refunds as well. How is this change impact taxpayers?
Yeah, definitely. For that purpose, I need to explain you what is inverted duty structure. So inverted duty structure is a situation where my output tax liability, or you can say output tax rate, is lower than my input tax rate. Let's say I am a manufacturer of one of the product where I am selling that product with the output tax rate at 5%, but for manufacturing that product, I am taking the input at 12% and 18%. So in that case, my credit gets accumulated because of this irrational situation. But there is a provision in the law which states that you can claim the refund against this accumulated balance of the ITC. For that purpose, the manufacturer needs to file the refund application for the refund. But whenever manufacturer file the refund application, it generally takes minimum 60 days times to get the refund if notice is not received.
Right.
So after this change, the taxpayer once filed the refund application, within when the refund gets acknowledged, within 7 days, up to 90% of the refund will be credited to his books of account.
Okay, that's a great news for the taxpayers who are now covered in the inverted duty structure after the recent rationalization of taxes by way of GST 2.0. So now moving further, there is one third important amendment relating to the change in the post supply discounts and issuance of credit notes. Could you briefly explain what kind of difficulties business were facing earlier?
This is a good move for small taxpayers. If you look at the condition which has been mentioned in the section 15.3, there it is mentioned that a taxpayer can issue a credit note only if the condition mentioned over there has get satisfied. The condition is like there should be a agreement, there should be a linkage of original invoice with the credit note, and third condition was the recipient of goods or services needs to reverse the ITC appropriately. So with this change, government has removed first and second condition, and the third condition has been taken care by the 2A 2B reconciliation or IMS portal.
Okay, right. These are the amendments which are important for taxpayers related to GST. So there are some important amendments relating to customs as well. So we will now move to the customs amendment. So in customs, in budget 2026 has introduced some notable changes in baggage rules. Could you briefly explain what exactly has changed for baggage rules?
Sure. The update, as per updated rules, a person of Indian origin, a person who is resident of India, can carry the baggage worth of rupees 75,000 as per the updated provision, and earlier the limit was 50,000, and for other citizens, you can say who is a foreign citizen, the limit is 25,000, and for them earlier limit was 15,000.
Okay, I heard about some changes in related to carrying gold. And so, what are the changes that limits change relating to gold?
Yeah, there is a change in the carrying gold limit as well. So the female passenger can carry a gold up to a 40 gram as per the updated limits, and the male passenger can carry a gold up to 20 grams. But in earlier provision, the gold worth of rupees 80,000 was allowed to carry by a woman, and gold worth of rupees 40,000 was allowed to carry by a man.
Okay, I heard some additional amendment which is related to the self declaration by the passengers, international passengers. That now there is some government will introduce some digital facility related to the declarations and the payment of custom duty, that that will ease the passenger for declaring the goods and then paying the custom duty on that goods at the airport. Okay, so and there are some tariff cuts related to the imports as well. So what are these changes, and have there been any significant changes impacting manufacturing and strategic sectors?
Yeah, definitely. To support Make in India initiative and energy security, duties has been reduced to or exempted on the several industry inputs.
Okay. So before we wrap up this segment, I would sincerely like to thank Akshay sir for sharing such a clear and insightful insights on the recent indirect tax amendments under Budget 2026. I would also like to thank our listeners for tuning in and staying with us through this discussion. We hope this session helped you understand the key GST amendments in the simple and practical manner. With this, we conclude this our session on Budget Pe Charcha 2026. Thank you all.
Thank you.